So order block is one of the vital concepts that plays very important role in your trading in your trading um your trading journey. So you need to understand what order block is all about, and if you wish to use order block as a strategy, then pay close attention to this training. Just take your pen and paper, because at the end of the training you'll be able to know what order block is all about, the rules of order block, which is the rules guiding order block, how to indicate a very strong valid order block, and order block entries, which is how to enter the market using different entry in on order block. So first, what's an order block? So a market order block is trading concept where a large quantity of buy or sell orders are executed at a certain price in the market. Now that spot where there is a large order placed, either it's a buy or sell. So that large order placed and the market start moving drastically to the upside or to the downside, that spot is where we indicate, or where we have an order block. All right. So it's very, very important you know this, because it helps you to make some informed decisions in your trading, especially when making a smart decisions, because this order block fall into the smart money concept. So you're able to know how to spot them whenever you see it. All right, if you are making use of order block as a strategy. Now we are going to dive into the chart to do what? To see the, so this is 1000 per USDT on 4-hour time frame. This order block can be used in any time frame, either lower time frame or higher time frame. It can be used in any time frame. It can be seen in any time frame. So it's literally apply in any time frame, whether you're a swing trader, a day trader, etc. So let's look into the bullish scenario of this chart. So if you look here, you see that the market started uptrend from here. From here, this spot, this is where the market started. So in a bullish scenario, we will consider the last bearish candle that formed before the market pull drastically up to the upside. Before the market pulled to the upside, leaving the market in inefficient means. And this inefficiency is what make the market to be imbalanced. Why? Because of these criteria, the rules I will mention. But then this last bearish candle, this red candle here, can be considered as an order block, because this is the last bearish candle that formed before the market start pulling with force, like before the market start applying pressure in going up. All right, so in this case, this last bearish candle is considered as our order block. Now let's look at what the bearish scenario. Okay, let's look at the bearish scenario. Okay, for here, in this case, we can see that this in the bearish scenario, we can see that the last bullish candle this is bearish scenario. So the last bullish candle that formed before the market start going down, all right, before the market start going down, so that last bearish bullish candle is considered as our order block. Now let's draw it like this, so you can see it. It's considered as our order block. Okay, so now this will make us to look into the rules of order block, because it's not just, you can't just see this candlestick. Order blocks, we use candlestick and candlestick analogy to what? To indicate the order block. All right. So we will now go into the topic on the rules of order block. Order block, there are rules, there are things you need to indicate that need to tell you, okay, this is order block, because you can't just wake up and say, oh, this is order block, or this order block is valid, or this one. So one of the rules is this. All right. The rules of order block must swept the liquidity. That is, strong order block must sweep the liquidity of the low or highs of the previous candle. Now, this is what I mean by order block sweeping the liquidity of the low or high of previous candle. In the bullish scenario, this last bearish candle, in the bullish scenario, this last bearish candle that formed before the market start pulling or pushing up to the upside, you can see that this last bearish candle completely swept the liquidity of the previous bullish candle. Do you see it? The last bearish candle, the last week of the bearish candle, let me zoom this so you see it. So do you see the last week of the bearish candle completely swept the liquidity of the previous bullish candle, which is the green candle. So the week of the bearish candle swept the liquidity of this one. So after it swept the liquidity of this previous candle, now the market start going up drastically. Like the market start pulling up drastically. Now this is one factor or one rule. Now another one is the market must leave inefficiency behind, all right, to generate market imbalance. Now this is what we mean by inefficiency. You hear me sometimes when I draw my chart, I draw fair value gap, like the gap. Now this gap is caused because of the inefficiency of the market, somehow called the market imbalance. All right, because the market is not balanced. Okay, so and as such, the market will always come back to fill that imbalance, or to fill that the gap. Now the market must leave inefficiency behind. Now after this bullish candle, after this bearish candle was formed, the market start going up, and when it start going up, it left inefficiency in the market, which makes the market to be imbalance. Now this is the inefficiency. The first week, you see, the first week or the body of the bearish candle did not meet or completely, this first week of the bearish candle right here, or the body, either the wick or the body, okay, anyone, and the lower wick of the third candle, okay, this candle you see here, this bullish candle you see here, the wick, which is this, the wick of this bullish candle, and the wick or the body of the bearish candle do not completely cover the body of the middle candle. You see this candle right here, this candle, this bullish candle, the wick of this bearish candle, which is the red candle, or its body, and the wick of the third bullish candle do not completely cover the body of the middle candle, which is the second candle. It do not completely cover the body. So that being said, we can say that the market is imbalance. The market is imbalance. The gap between these three candles, the gap in between, this gap um, this gap between them, this gap between the first candle, which is the bearish candle, and the third candle, which is the bullish candle, the gap between them, as long as they do not overlap or completely cover the middle candle, so we can now say that the market what was or is imbalanced because of the inefficiency. All right, so and this gap between them is called fair value gap. Fair value gap, otherwise known as FVG. All right, so that is for what the bullish scenario, right? So you can see it. So the gap between them is called fair value gap, and this gap between them is as a result of the market what imbalance. The market is not balanced, and as such, the market will always come to fill that imbalance. We don't know how long it's going to take, but we know that the market will usually come to fill that imbalance. Now, the third rule, I think I've mentioned the first rule. The third rule here states that it must be unmitigated. Now, unmitigated means that, I think I've explained this. The third rule means it must be unmitigated. It means that the lower wick of the third candle, which is this bullish candle, and the higher wick of the bearish candle must not or completely cover the second candle, which is the middle candle. It must not cover that candle. That is to say, it is unmitigated. So it must not mitigate. Do you understand? It must not mitigate. So if it is mitigated, or if it completely covers the body of the middle candle, we can now say that the other block is not valid, is no longer valid, because the market will now be in efficient movement. The market will be in efficient, not inefficient. Like the market will be imbalanced, will be balanced. The market will now be balanced. I don't know whether you understand me. The market will now be balanced. We cannot say that the market is imbalanced again. The market is now balanced, just like this one. Now let me show you what I mean. Here, as you can see, this red bullish candle, the wick of the bearish candle, the wick of this bearish candle, as you can see, this long bearish candle, the upper wick, and the lower wick of the third candle after the middle one, completely cover the middle candle, which is this. From the upper wick and here, it completely overlap, like it covers the body of the middle candle, which is this bullish candle here in the middle. So we can now say that this is not an order block. This is not an order block, right? So if you see any gap, all right, between these three candle, just like this one here, just like this one, this is the bearish candle, which is long hammer here. All right, so if you see any candle like this and you have the upper wick or the body and the lower wick of the third candle after the middle one, the lower wick of the do not completely cover the middle one, we can now say that is an order block. But there is something that makes it more valid or more strong. Do you understand? But as long as there is gap between them, that is market inefficiency or market imbalance. So as such, market will always come to fill the imbalance, so that the market will be balanced while continuing its upward or downward movement or any market direction. All right, so another rule, all right. Another rule is an order block must have or leads what to break of structure or change of character. Very, very important. Now let me show you. If whenever order block is being formed to the upside, it must lead to what break of structure or change of what character. This is where the market will be telling us, indicating whether the market will continue it what directional movement, either is upward or downward movement, or the market will make a change of character, which means indicating a possible reversal movement. All right, that is change of character. Now if you look here, let's look at the market here. The market was previously what downtrend, right? The market was previously downtrend here. From this spot, market was previously downtrend. Now it gets to here, it gets to this zone. The market started making change of character to the upside. But here the market was previously downtrend. And if you look at here, we have what we call we already have what we call order block here, because if you look at here, because the market was pushing greatly to the downside, it left some imbalance, some gap, some imbalance here. So after that movement, it gets to this point, to this demand point, the market starts what consolidating, which means making a possible change of what character or change of trend. Do you understand? So this point now is one of the rules that indicates that from here we will experience a bullish order block, and this is what we experience here. Now after we experience this bullish order block here, the market drastically pushed up, causing break of structure. All right, so this break of structure is the point where the market make a short reversal and continue it what upward movement, or in the downtrend is where the market makes what is where the market makes a breaks the structure and continue the downward movement. That is the what is it called, bearish scenario. All right, now here is where we have break of structure one. So after this order block was formed, it pushed back, leaving some the market imbalance here, this gap between the three candle, this gap, the another gap here. So you can see there's another gap here. So there is another gap here, as you can see it, because the what's it called, the higher wick of this candle, this bullish candle, the higher wick of this bullish candle and the lower wick of the third candle after the middle one, the lower wick of this third candle do not completely cover this middle bullish candle. We can now say that, okay, there is an imbalance there too. Okay, there is a gap between them, which is making the market to be what not balanced. So the market is imbalanced. So as such, the market will always reverse back. As you can see, the market pull up, gets to this point, the market start making some minor retracement here. As you can see, the market start making minor retracement. After the market made some minor retracement, now it feel at least 40% of the market imbalance or the market gap. This gap, the market make at least 40%, feel at least 40% of the gap, then break that structure again. Do you see it? The market break the structure, which means the market broke what the this resistance. Remember what I told you guys about support and resistance, right? So the market, this resistance that was supposed to serve as a resistance zone, and the market break it and continue the upward movement. All right. So the same thing happened here. This is another break of structure. So as long as the market is going up, it's making some minor retracements, pushing to the upper side. We are experiencing break of structure. See, this is another break of structure. Okay. Now it gets to this point. It gets to this point. The market do not make any break of structure here. Okay, we have another one here. This is another break of structure. Minor break of structure here. All right. So it gets to this point. This is where we have what? This is where we have a minor supply zone. So this is where we have a minor supply zone, and this is where we now have another other block, as you can see here, in case of bearish scenario. I don't know whether you guys are understanding me. So hopefully, if you don't understand well, you can ask question. All right. So if you don't understand well, you just come to my DM, ask question in the group. All right. So, but I'm trying my best to explain this in a possible way so you understand. So I think these are the rules of what indicating order block. So, and this rule will make it for you to find a strong order block here. How to indicate strong valid order block. Now, for you to indicate a strong valid, now there are strong valid order block, while there are also minor order blocks, while there are ones that are very strong. Now, how do you indicate a strong value order block? A strong value order block must meet the whole criteria. That I mentioned as the rules before you now consider it as a strong valid order block. And as long as the market is going up or coming down, forming order block, where there is another block forming break of structure, the market will always come to fill the other block. The any other block that is that previously formed, the market will always come to fill it, go up and fill the other one. So that's how it's going to be doing until it completely take out all the market imbalances in the market. All right. So now, for you to indicate a strong valid order block, it must meet the whole rules. Number one, I've mentioned it. It must completely sweep the liquidity of the previous candle. This is what it means to completely sweep the liquidity of the previous candle. So this bearish candle here, this red candle, the lower wick of the red candle completely swept the liquidity of the previous bullish candle here. You can see it before it now drastically push up to the upside, causing the market imbalance, the inefficiency in the market. All right. In forex trading, there are terms in forex and also some terms in crypto, but at the same, they are saying the same thing. All right. So the red candle here, the red candlestick, which is the bearish candle, form, and during its formation completely swept the liquidity of the previous candle before pushing to the downside. Then another thing it must meet is that the price must leave some inefficiency behind to generate the market imbalance. That inefficiency is what causes the market imbalance. So the market immediately this red candle, immediately the formation of this red candle, the market pushed up to the upside, leaving this gap between this bearish candle and the third bullish candle. The gap between them, this middle candle, there's a gap. Why? Because the body or higher wick of the bearish candle and the lower wick of the third candle, which is the bullish candle, do not completely cover the middle candle. There is a gap between. So we can now say that there is an imbalance there. So continue going up, you see such cases where the markets experience some imbalance in the market. So as you can see it here, another one, then here another one again. So you can see here, so here another one. So this is the last bearish candle, and as you can see that the market, this last bearish candle completely swept the liquidity of the previous candle. But then let's see if there is a gap between the what, if there is a minor or major gap between the three candle. So there is a small gap, not only that huge gap, but let's draw it like this. Okay, so this small gap you see here, the market tend to fill it up, no matter how small or big the gap might seem. Okay, might seem in your eye, market will always come to fill it. So another case here, in this case, there is also a gap, because this other block here, this bearish candle, okay, there is a little gap, not that strong, okay, not that strong, but then we might consider this as it is not that valid, but it's kind of valid. But when you are analyzing and you now see that, okay, this gap is not that much, but the gap afterward is much, which is this one, you are seeing here, the higher wick of the bullish candle and the lower wick of the third bullish candle do not completely cover the middle bullish candle. Now there is an imbalance here. So there is an imbalance here. Okay, there's an imbalance here, as you can see it. All right, and the market, as such, the market will always come to fill it. So another one to indicate the strong valid order block is that I've explained it. The lower wick of the third candle and the higher wick of the first candle must not cover the middle candle. So that gap between them is called fair value gap, because that is market imbalance as a result of that upward or downward movement. All right, so another one is that there must be an experience of what, break of structure or what, change of character. The market will be experiencing a break of structure, indicating the continuation of the market trend, either a downtrend, uptrend, or ranging market. So it indicates that the market will continue what, breaking structure, or the market will get to a point where the market will start making a change of character, which is in abbreviation is called chalk, right? So a change of character, as you can see here, the market goes to this point, the market starts making change of character here, as you can see. So here the market starts making what, change of what, character, as you can see. So the market made a minor change of character and pull to the downside, breaking structure here, as you can see. But then it still went up and continued going down before it gets to here, and the market still continue it uptrend. So, all right. So now that you know what order block is all about, as you can see, now let's look at bearish scenario. So this is a bearish case. All right, this is a bearish. I think this is a bearish case, right? So as this is a bearish case, bearish case, don't mind me. So as you can see, the market is making multiple break of structure here. Okay, the market was making multiple break of structure. As you can see, let me use this. As you can see, the market make break of structure here. I think I need to increase this so you see it very clearly. So the market make break of structure here, another break of structure, as you can see it. Then the market also made another break of structure here. Okay, as you can see it. Then the market also made another break of structure. The market was breaking structure. All right. Now it comes to here, and this break of structure is what result to what? Higher highs. Remember what I taught you about the market structure. So higher highs, as you can see, higher highs. The downside is the lower high. So as this market is making this high, it gets to this point. Now this is where we now have what? The supply zone. This is an area of supply. This area of supply is where the market starts making some change to what? To now change the direction from the upward movement, which is the bullish movement, to the downside. Now this change of market movement is called change of character. Now it gets to here. Now the market, this is the point. At this point, there is a large sell order. There's a large sell order, and this large sell order is what's prompted to have what? An order block. And what are the things you need to know to confirm that, okay, we have order block at that point where the market is making a change of what? Direction. Now that is when the rules will now came in place. Now if you look here, if you look at this point, if you look here, you will now see that as the market is making this change of its market trend from the upside to the downside, so the market is making that change. So this is where we have the change of what? Character. This is where we have the change of character. How? Because the market could not make a further movement to break this swing, to break this swing high here. The market could not make a further movement to break the swing high, which result to the break of the market, the trend, the uptrend structure. So the market starts coming down, making a change of what? A change of market direction, which is change of character. So from here now, you can see here, you draw this line. From this line here, you cannot confidently say that the market have made a change of what? Character here. At this point, you cannot confidently say that the market have made a change of character here. Why? Because the market could not push further up, and the market start making some reversal. And remember what change of character means is that point, that zone where the market start making a reversal, okay, to either the upside or to a major reversal, which is market reversal to either the upside or the downside. But here, at this case, the market is making a major reversal to the downside, which means indicating the end of what? The end of bullish trend, indicating the end of bullish trend. So this supply zone is where we have the end of what? bullish trend. Then the market want to start bearish trend. Then for the market to start bearish trend, it need to make a change of what character, or change of what market or market trend. So because the market started making that reversal to the downside, now it leads to that change of character and now break structure. It now completely take out the market's uptrend to start the downtrend movement. Breaks this line now, this line now, this trend line. I remember this trend line serves as what? Support previously. Now the market breaks it. The market breaks that support. All right, came down here and pulled up, break the structure again, which is break of structure. See, let me draw it so we can confidently see, because for you to know that okay, the market is now experiencing a downtrend, you need to wait to see what will happen. If the market do not break the change of character, just know that it's not yet valid. You need to wait for the market to break it. You need to wait for the market to break the change of character, the chalk. You need to wait. So when you wait, if the market do not break it, just know that it's not yet valid until the change of character is broken. Do you understand? Until this line I drew here is, so you need to wait for confirmation, because confirmation is where we experience patience. So when you see the market is all about patience, so you need to experience this patience while waiting for what will happen in the market. So as you can see, this market confidently gave me a break of change of character here. So I can now say, okay, the market is likely making what? A downtrend movement, as you can see, and continue the downtrend. Now at this point, this is where we might look for trading opportunity using order block. Now what happened here? This area now, if you look at this area, the last bullish candle, remember in the uptrend, the uptrend is last bearish candle, but downtrend, when the market is making a downtrend movement, that is the last bearish candle. Sorry, the last bullish candle. As you can see, this green candle, the last green candle that formed before the market starts pulling down drastically to the downside. Okay, we can now say that the market is what left some inefficiency in the market, causing the market to be imbalanced. Now the gap between them is what we call the fair value gap. All right, so as you can see, you can now say that this is a valid order block. How is it a valid order block? Why? Because this bullish candle here, the higher wick of the bullish candle completely swept the liquidity of the previous candle, which is the bearish candle. Completely swept the liquidity of the previous candle. Now after its formation, now the market starts applying pressure, which is what? This is where the large sell order was placed. This is where the last sell order was placed. Now after its placement, the market started dragging down. Now during this drag down, you can see that the lower wick of the bullish candle, this lower wick or its body can be low, it can be weak, it can be body, and the higher wick of the third bearish candle here do not completely overlap or cover the middle bearish candle. This candle, it do not completely cover it, thereby leaving a gap between them. We can now say that this is what? a what? This is an order block, and because it met almost all the criteria or the rules of indicating order block, we cannot say it is a strong order block. It's a strong valid order block. Do you understand? So we cannot say it's a strong valid order block. Another thing that gave us, or I will say that okay, this is a strong valid order block, is that it leads to break of structures after the market make a change of character here. After the market made a change of character here, the market drastically pulled down. And after it pulled down, make a minor retracement. It made a minor retracement to the upside. Then, with its force, push down to the downside and break the structure and break this structure here. So it breaks the structure here and continue it down before it gets to this point. Now it makes a retracement again. Now breaks another structure here. Breaks another structure here. As you can see it breaks another structure here. So from this point to this point, this is where it breaks another structure. All right, it continue breaking the bearish structure. So as you can see it, so it breaks another structure here. Now the market starts pulling down again and makes a minor retracement to the upside, and upon that retracement, it drastically pulled down again to break another structure. As you can see it, so the market continue breaking structure. As you can see it, okay, I think there's a wick here. The market continue breaking structure here. As you can see that structure. Now it breaks another structure here. It breaks another structure here. Remember what I told you, what I said about the rules, that the high quality order block must lead to what? Break of structure or change of character. Now it gets to here. Remember, the market was previously breaking structure to the downside. All right, it was previously breaking structure to the downside. Now it gets to here. The market could not what? Break any structure again, thereby making a change of character, indicating that the market could not break any structure here. As you can see it, the market have not broken any structure again. As you can see it, they have not breaking. This is where the market is currently right now. This is the current market price currently, but the market have not made any what? It have not broken this structure, which means this is indicating that we might experience what? Change of character here. Might experience change of character. As you can see it. So this market is telling us, okay, we might experience change of character. That the market, this is where the downtrend might stop. This is where the downtrend might end. Now, the uptrend might continue from here. Which is, if that is the case, then this area, this zone, is a change of what? Character. This zone you are seeing here, this zone from here, this zone we are seeing here, might be a change of character. So it might be a change of what? Market trend. Might be a change of market trend, that the market will now prepare for bullish trend. So that is just it about how to rules of order block and how to know a valid order block. Now let's move on how to use order block to enter a trade. All right, very, very important. So I think we have gone for 4 minutes. So let me use how to use order block to enter a trade. Now there are 4 type of order block entries. There are four type of order block entry. So in a bullish scenario, let's say you have indicated the concepts, the factors behind order block. Now you want to enter the market, right? You want to enter the market. Let me find the one that's triggered. Okay, now look at here. Guys, remember, there's something I forgot to say. It is not whenever you see a gap, just like this, I want to show you something. Whenever you see a gap that gap is considered as fair value gap, which is the market imbalance, but then the first candle did not completely swap the liquidity of the previous candle. Okay, we can still consider that as fair value gap or market imbalance. It's just that the order block is not too strong, it's not too valid. Do you understand? But then there is a fair value gap there. Okay, look at what I want to show you. Look at what I want to show you. See, here, this green candle here do not completely, the higher wick of the green candle do not completely solve the liquidity of the previous bearish candle, this red candle now. But then there is a gap here. There is a gap. There is a gap. There's an imbalance there. There's an imbalance here. As you can see it. We can now say that, okay, there is a market imbalance here. Yes. There is a market imbalance here. So, what we now be considering, okay, since it does not meet all the requirements, the order block is not that strong. But then, we can still consider it. Just, this is a simple market sentiment. Alright. So, on how to enter the market, we have 4 types of entry. We have the lower body entry, the weak entry, the mid body entry, and the upper body entry. Alright, so first, the lower body entry is what we're going to lower body. Now, this is what lower body. Let me clear this chart. So if you look here, lower body, this okay, so look here, the lower body entry. I want to show you something. Okay, so this is the body of the candle. Remember, this is the body of the candle. This red candle right here is the body of the candle. This red candle is the body of the candle. This small red candle is the body of the candle, right? So let's assume you have spotted your order block and you want to map out the order block for you to wait for possible market trading opportunity so that you can enter the market. Now, this body of the candle is where you will mark out. Either you use rectangle to mark it out like this. Alright, mark out like this. Let me increase the transparency of this so that you can see it very clearly. So you use to map it out like this. The body of the body of that what's it called? The body of what? The body of the candle, the order block. Now you now pick a long position and place it place it like this. All right. Now, your stop loss should be above the lower wick of that bearish candle, lower wick of this candle. So it's you just leave it above the lower wick. All right, above the lower wick. So as you can see, you just place at a achievable, depending on, because this is giving us I think three. I think one is to what? One is to either 4 or 5. Yeah, one is a 4 or 5 risk to reward ratio. So as you can see it, so the market, this means that as long as there is a market imbalance here, there is a gap here, there is a fair value gap here. As you can see it, this is a fair value gap, which is indicating a market imbalance. FVG. So market imbalance. So the market will always come to fill that imbalance first. Even if there are multiple imbalances down below, the market will surely come to what? Fill them up. The market will surely come to fill them up. All right. Now let's assume you enter the market using the body of the candle. So this means that when the markets come down and the market, there is a possibility of the market picking your order and going to the direction for your what? The long direction you have already placed. All right. After filling the what? The imbalance here. So the market will now take in your what? Your order block entry, and but then it is sometimes you will tend to miss entry, just like this. If I use, let's say I use the body of the candle, I will have a miss entry here because the market did not trigger my entry, as you can see it, which is normal. Sometimes it happens. So another form of entry here is what? The weak entry. This entry offers the high possibility of your order triggering, but then there is a huge risk. It's a huge risk. You know why? Because let me say now, the weak entry means that you're entering the market at the top wick of the candle, the high wick of the red candle. That is where you enter the market. That is your entry. Now, what you need to do is just pick your rectangular tool. Now place it at the top of the wick, okay, and the lower of the wick. Make sure that it covers the lower of the wick and top of the wick. Now you take your long position and place it. Make sure it's reading between the line of that of the rectangle you have drawn. Now, and your stop loss should be either somehow below the wick, which is the rectangle you have drawn. Make it somehow below the wick, or at the exact wick. Do you understand? But then there is a high risk here, because it will now make your risk. It will expose you more to the risk. Do you understand? Because if you check here, you will now see that you are having 4%. You are risking you are having 4% risk here. You can see it. You are having 4% risk, 4.14 risk. All right. Now, this kind of entry usually triggers because sometimes the market will now come and touch your wick and feel the wick. In fact, there's a high possibility of your entry triggering, but then the risk is high because you will now be trying to cover the lower wick, especially when the wick of the candle, this other block, when the wick of this other block is much, especially when it's much, you will not be seeing that you are exposing yourself to too much risk, you understand, in the market. So but then the possibility of your order triggering is high, but despite that the risk might be high. Okay, depending on the formation of the candlestick, the wick of the candlestick. Now, as you can see the market trigger, as you can see the market triggered, as you can see it triggered because we're using the wick entry, the higher wick entry, the market trigger, and boom, to the upside. There is a successful trade here. Okay, now another form of entry is what? Another form of entry is mid body entry. Now let me use another this thing to show you this form of entry, mid body. This mid body is actually one of my favorites because it's one of my favorite entry though. And you know that when you want to enter the market, the formation of that candlestick, the longer of the candlestick is what will determine what kind of other block entry you are going to use. If the candlestick is just long as this one now, as this one, if it is long like this, then you may not want to use wick because you are exposing yourself to too many risks, you understand. So let me use another, this one now. Okay, let me use another, this one. Let me use this one. Let me use this one. Okay, I think I will use bearish what's it called? I will use bearish trend to indicate this mid body entry. I will use bearish this thing. I'm just looking where I will get a proper confirmation of what I want to say. Okay, mid body entry. All right, so I think I've seen one here. So mid body entry simply means you are entering the market. You are entering the market. Okay, you are using order block to enter the market. But that candlestick example now, remember what I say about the bearish candlestick. Okay, look at it. This candlestick now is order block because this candlestick is a very strong one. It's a very strong order block. You know why? This here is a very strong, this, we can consider this bullish candlestick, this green candlestick as a strong one. You know why? Because the higher wick of it completely swept the liquidity of the previous bullish candlestick. Now we can now say that this is after the formation of this bullish candlestick, the next one that formed is a bearish candlestick that drastically pulled down the market. Okay, this is where the large sell order was placed, and the market started going to the downside, now leaving the market imbalance here. As you can see, there is a low, there is a little gap between them. There's an imbalance here, as you can see it. There's an imbalance from here. the here to here, there is an imbalance here. Do you see it? This imbalance needs to be filled in the market. And remember, this market is downtrend, right? It's downtrend. See it? From that place is downtrend. Now, I will now have to do what? Let's assume the market is still here. Let's assume the market is still here and the market is coming up. Okay? Okay? The market is coming up. So what will I do? I will have to draw this gap here. This gap here. Now, this gap serves as what? My what? It serves as the fair value gap, the market imbalance. I will not have to indicate it. All right. So this is the fair value gap. All right. Now, but then I want to use the mid body entry to enter the market. So what do I need to do? Since I've indicated this order block, this is the order block. I will now have to map it out like this. I will map it out like this. I will just map it out like this. So what I will do is what? This mid body, the mid body of the middle body of this bullish candle, the middle body will serve as my entry. I will just here leave it like this. So when I leave it like this now, I will now pick my short position because this is what? Bearish market. I will now pick my what? Because I know that the market will react to that imbalance. The market is coming up. The market was previously coming up to react to this imbalance. Remember I say the market will always feel the imbalance and continue its downtrend or uptrend movement. The market will always feel the imbalance. So I will now pick my short position like this and place it like this now. So and drag down to my realistic profits I want to make. So at this it now I will now choose my stop loss to be a little bit above the higher wick of this other block here. Now the higher wick, depending on what I can afford to lose, what I want to risk, which is this is about 3%, right? It's about 3%. So this is the body of the candle, so as you can see it. So when the market, if the market is coming up to feel the imbalance and react to the other block, then it will pick my entry and start going down. But as you can see here, the market did not pick that entry. As you can see here, the market did not pick that entry. It is normal. Okay, it is normal. It's not every of your entry the market will pick, but the possibility of your entry picking up is also high, therefore reducing the risk. You understand? Therefore reducing you won't have that much risk in the market. You understand? So, and the market will start. Sometimes this kind of entry is sniper entry. This kind of entry is sniper entry. Okay, when such thing will happen, like when your entry will trigger if your entry triggers, immediately it triggers, start going in your own direction that you have already predicted. It start going in your own direction. After, like if you look here, I mean that this market triggered here, boom, and the market will start going in my direction. That is called sniper entry. Now the other form of entry is the upper body entry. Upper body entry. Now this is the upper body entry. So instead of me placing the entry at the middle of the bullish that bullish candle, now I will have to drag it to touch the upper body. Remember this upper body. This is the upper body now. This is the upper body. Yeah, that point. This is the upper body. So this is the wick. Now this is the the body, which is the closure of the what? The closure of the candlestick. So it is the upper body. So instead of me placing the entry at the middle, I will now place it at the upper body. This form of entry reduces risk, and also it reduces risk. You know why? Because if I want to place my trade, I will just pick it like this, boom, here, and the market, there's the possibility of the market touching my entry is very rare, because sometimes the market will not get up to that point, and you now have a missed trading opportunity, a missed entry opportunity, and the market will start going in direction. It's kind of heartbreaking, you understand? So as you can see, it's but then it reduces risk. Yeah, the risk is small, because if I choose like this now, you see it is 2.4%. As you can see, the risk is 2.5%. So it reduces risk. But then if your order trigger, that means you are having a successful trade. Like the trade is somehow, except the market decide to do otherwise, and that's why you have stop loss there. So this is for the bearish scenario case. In the bullish scenario case, the same thing. So that's just it. The bullish scenario case, the same thing. So again, there is something you need to also understand. When you are using order block, you need to spot out areas of liquidity, so that you will not be you will not enter the market and market will kick you out. The areas of liquidity. Okay. How do I mean by areas of liquidity? Normally, let me find something. Let me go to another chart to show you something. Areas of liquidity. So, there are too much liquidity in the market. So that's why you need to making some smart, informed decisions. So you will not be used as a liquidity exit, because let me go to I just want to find that other block so that we use it. I will use it. See, exactly. See what I was looking for. Now, you see this market now. This is JTO USDT on 1 hour time frame. You see, okay, let me check 4 hour time frame. Okay, boom. You can see it. You can see it now. This is 4 hour time frame. 4 hour time frame. Okay, let me use that 1 hour, because it's kind of giving me exactly what I want. So if you look here, you will see that there is a bearish order block here. There is a bearish order block here. How? Remember what I told you, that the last bullish candle that formed before the bearish candle that starts selling, the market starts selling. The last bullish candle that formed, and the bullish candle have met the requirement to indicate as an order block, whereby this bullish candle completely swept the liquidity of the previous bullish candle here. Let me use my indicator. The last bullish candle completely swept the liquidity of the previous candle here. That means after the liquidity swept, now after the liquidity swap and the completion of the formation of the bullish candle, the next candle that formed, the market starts continue selling. The market continues selling, thereby pulling much selling pressure down, leaving the market in inefficient movement, because as you can see the gap. There. So there is gap between this candlestick Okay, this red candlestick, the lower wick of the candlestick and the higher wick of the third candlestick do not completely cover the middle, this large candlestick here, this red candlestick. So the first lower wick of the first candlestick and this one do not completely cover it. So that means we now say that the market had an imbalance, and that imbalance is called the gap between these three candlesticks is called fair value gap. Fair value gap, right? So which the market need to fill. Now, this, after you must have spotted this, okay, after you must have spotted this, after you must have spotted this, see here, you see this area, this this area is area of liquidity. This is a buy, like this is, as you can see, the market is going in a ranging from building liquidity at the upside. The market is going in a directionless movement, like the market is going in a ranging market, but this ranging market is stacking up liquidity at the top, and this liquidity need to be what? This liquidity need to be filled. The market need to take out this liquidity and what? Continue whatever I want to continue. Do you understand? Continue the down movement. Do you understand? So now a normal retail trader, probably you spot out some this thing here, you spot out other block here, or maybe you want to use support and resistance. Okay, let me say support and resistance. So a normal retail trader, we want to what? Once the market is here, as long as the market is already here at this point and the market is coming up, and somebody that want to use support and resistance, let's say you want to use support and resistance, you now pick your short position. A normal retail trader will want to place, because your psychology, it means that okay, once the market hit the resistance, it will repair and start coming down. But then you need to also look at some things that might affect your trade. So a normal retail trader, we want to place entry here, okay, and place stop loss somewhere here. Do you understand? 3%, right? Now, what happened? The market came here with major spike, take out liquidity, take out this liquidity, and after the market take out this liquidity, this area of liquidity right now, call it liquidity trap. So this liquidity trap, now the market took it out, okay, and start coming down, okay. So that is also, you need to be smart. You need to be making smart decisions. So since you have seen that the market is building liquidity here, since you have seen the market is building liquidity here, okay, at the top, this ranging market, this market that is ranging, is building, kind of building liquidity here. So you need to be that, and you have spotted this strong order block. You have spotted this strong order block above this ranging market. This strong order block is in the middle of this liquidity. So you need to be, for me, what I will do is this. I will, instead of me placing my entry here, instead of me placing, in as much as I may spot out order block here, just like I'm seeing here, just like I'm seeing it here now. This is other block, sir. Okay. But then I will wait, or you know why I will wait? Because I'm seeing some kind of liquidity. So I don't want to be used as a liquidity this thing. Do you understand? I don't want them to use me as a liquidity exit, the institutional trader. So since I've spotted this order block here, what I will do is very simple. I will just, from here, drag the order block. So remember, there is fair value gap there, and this order block, I will now drag it like this. So instead of me placing my entry here at this line, this resistance line, placing my short entry at this resistance line, I will now have to what? because the market as long as the market is in the downtrend, the market need to take out that liquidity and also that fair value gap. So since I'm seeing something like this, I will place my short entry like this hit, and my stop loss somewhere above the candlestick, the higher wick of this other block candlestick. Now set a realistic I will now set a realistic take profit, not greedy. Okay, 10, so which is about 1:3 risk to reward ratio. So do you see it? The market starts doing this accumulating, and boom, take out liquidity and hit my entry and start going down. So this is what makes some people to be, when you let's assume now you place a short entry here. You place a short entry here, right? Okay, let me delete this first one so that it's not confuse you. Let's assume you place a short entry here. All right. And the market take you out of the market. The market take you out, hit your stop loss and start going in your direction. Be like, wow, your village people is after you. So these are the things you need to spot out before you place. And the same thing that is applicable to this sell side, this bearish trend is applicable to bullish. So that's it for this training, right? See you in the next training, all right? So that's it for now. Bye.